I'm Caitlin, and I'm the Marketing and Communications Administrator here at ASECU. Today, I'm going to be talking to you about your financial future and debt. If you're like most people at some point in your life, you will take on some kind of debt, a credit card, an auto loan, maybe a mortgage. But what type of debt, how much debt you take on, and for what purpose are all things that can affect your financial future. After this session, you should be able to recognize the effects of late or missed payments, explain the effects of debt on a person's net worth, and distinguish between good use and misuse of credit cards. Let's get started. Imagine you're a recent college graduate and you've received a job offer in a new city. You're happy with the position, the responsibilities it entails, and your salary, but you realize you have some choices to make. Where will I live? Should I find a roommate? How will I get to and from work? These decisions will impact how much money you will have to cover everyday costs, such as grocery and utility bills, as well as your monthly student loan payments. For most people whose financial resources are limited, figuring out how to allocate resources involves making decisions about debt. Get ready to learn how to manage your financial future and debt. We're going to match the definitions with the correct key term. See if you can answer before I put the answer up there. The amount of financial trust extended to a person or a business by a lender, a loan. The answer is credit. A card authorizing the holder to buy goods and services that can be paid for. Is a credit card. Money owed is what we call debt. Payment for the use of money, a fee paid to use someone else's money or money earned from allowing someone else to use your money, is interest. And money borrowed that must be repaid, usually with interest, is a loan. You incur debt by borrowing money that you promise to pay back with interest. We're going to select each image and learn about each type of debt. A mortgage is a loan taken from a bank to buy a home. A mortgage is a long-term, usually between 15 and 30 years, debt. Since homes are pricey, mortgage payments may take up 1/4 to 1/3 of one's salary, but interest rates tend to be moderate. A car loan, debt is incurred when buying a car. A car loan is usually repaid over the course of 3 to 5 years. Most car loans charge modest interest rates and cost borrowers a few $100s per month. Depends on what kind of car you buy. Student loans are money borrowed to pay for higher education expenses. Student loans carry relatively low interest rates. Repayment can stretch out over many years after graduation. I'm sure a lot of you are in the process of getting student loans. Money borrowed from credit card companies, credit card debt that comes with high interest charges that can quickly add up if not repaid promptly. Out of these four things, credit cards usually have the highest interest rates. How much debt you carry also impacts your net worth. So in this column, it's green for assets, and your assets would include your cash, stocks, bonds, and everything you own. Imagine that you have $50,000 in the bank, own a house worth $200,000, and a car that's worth $30,000, and you have $10,000 worth of stocks and $10,000 worth of possessions. Your total assets would equal $300,000. But in red is what you owe. You have a $150,000 mortgage on your home, a car loan for $15,000, and student loans totaling $35,000. So your total debt is $200,000. That would make your net worth $100,000. Your net worth is the total monetary value of all your assets less the total value of all your debts. Your net worth is $100,000. It comes from subtracting your debts from your assets. So now we're going to try it. Before I put them in the columns, try to guess what is an asset and what is a debt. So you have a condominium worth $115,000. Would that be an asset or a debt? That would be an asset. You have an auto loan for $5,500. That would be a debt. You have a mortgage for $85,000. A checking account with $3,500. It's an asset. Your car is valued at $12,000. Savings account with $4,000 in it. Baseball card collection worth $1,500. You have student loans for $10,000 and a credit card bill for $2,500. No matter what type of debt you take on, you will be expected to repay loans on schedule, usually in monthly payments. Late and missed payments have consequences. With a mortgage, late payments incur extra charges, while chronic failure to pay can result in foreclosure, which is when the bank takes possession of your home and evicts you. For car loans, tardy payments lead to late fees, and repeatedly missed payments can lead to repossession of your vehicle, could also affect your credit. Student loan, failure to repay can result in additional penalties, such as not being allowed to restructure the loan. It may even lead to the government to garnish or withhold money from your paycheck until the debt is satisfied. With credit card debt, because credit card debt carries such high interest, late payments can cause the amount owed to spiral upward, which can keep you from borrowing money elsewhere and bring about collection agencies and legal action. Missing payments or making late payments can also affect your credit score. Your credit score is like a report card that grades your reliability when it comes to paying off your debts. The higher your score, the more likely institutions are to let you borrow money, and the more likely they are to offer you favorable terms for interest rates and repayment options. If you have bad credit, some banks will not loan money to you. This can prevent you from securing the funds you need for big purchases, such as a car or a house. If you can get a loan with bad credit, the amount of that loan is likely to be smaller and the interest rate you pay is likely to be higher. If you buy if you buy a $1,000 computer with a credit card that charges 17% interest, how much will the computer cost if you do not pay back the money when your next bill is due? The computer will now cost you $1,170. If your payment is late, you would also have late fees, which would increase the amount that you owe. If you fail to pay that loan for another month, how much will you now be paying for that $1,000 computer? You'll pay $1,368 plus late fees, and your interest rate can go up for late payments. A late fee of $40 is common for a second missed payment. Using a credit card can be some of the most expensive money you borrow. What you must understand is that a credit card is a tool, and like any tool, it can be helpful when used wisely and destructive when used foolishly. We're going to watch this short video on smart spender credit tips and using credit responsibly.
Smart spenders know how to use credit responsibly. Here are 8 tips to use credit without abusing it or letting it abuse you. Smart spenders don't run up debt just because they have credit available. They know how much debt they can afford and stay below that amount. Smart spenders take time to read each contract and loan agreement before they sign anything. They know how interest, fees, penalties, and payments are applied so they don't get hit by unexpected issues. Smart spenders don't let debts linger, especially when they can be paid off quickly. They aim to pay off credit card balances in full every month or in as few billing cycles as possible. And they check terms to see if loans can be paid off early without a penalty. Smart spenders know it's better not to hide from creditors if there's ever a challenge paying back debt. They call lenders and creditors to make arrangements when issues arise, requesting a forbearance or temporary adjustment to the payment schedule. Smart spenders don't use credit cards as a license to spend. They always comparison shop before spending and shop with a list. So that means not buying on impulse because of flashy sales displays. Smart spenders are prompt about reporting lost or stolen cards, and if there's a potential for identity theft, they place fraud alerts with the credit bureaus. Smart spenders only give out credit information over the phone if they initiated the call, or if they have verified the caller's identity. Giving out information to the wrong people can lead to identity theft and fraud. Smart spenders only enter credit card information on trusted, secure websites. And they never enter credit card information after clicking an unsolicited email that shows up in their inbox. Those are just a few ways smart spenders use credit so it doesn't cause problems. For more information on how to be a smart spender, visit consolidatedcredit.org.
So, smart or foolish? Jack and James are planning a trip. They are both considering using credit to pay for it. We'll select the image. So Jack earns a low salary but has 6 months' salary in savings, has a roommate which keeps his rent low, he does not have a monthly car payment, and he can pay off the entire cost of the trip as soon as he receives a credit card bill for it. James earns a high salary but only has a few $100s in savings, pays high rent for an apartment downtown, he just took out a car loan with a hefty monthly payment, and would need several months to pay off the cost of the trip. Who should charge the cost of the trip on their credit card, Jack or James? James would not be able to pay the charge right away, so he would pay quite a bit of interest to the credit card company. Using a credit card to pay for the trip is a foolish decision for James. But Jack will not pay any interest, so using a credit card to pay for the trip is a smart decision. Living entirely without debt is unrealistic for most people, so the goal is to be cautious and limit your risks. You can do this by taking on as little debt as possible and making sure that you can pay for the debt you do take on. Consider the following strategies. Live within your means, which means not spending more than you have available to spend. Save as much money as possible. Rent your home rather than buy it, though know that signing a lease also means promising to pay a specific amount to your landlord each month, and failure to pay rent can result in eviction. Although renting a home also does have its downsides. Choosing not to buy a car and rely on public transportation, or decide to buy a less expensive used car instead of a new one. Devote extra resources to paying down student loans as quickly as possible after graduation, and pay for most goods and services with cash or a debit card instead of a credit card. There is a student activity that you'll be given for this session. Thank you for joining me and talking about your financial future and debt. I hope you all learned some things you might not have known before. Have a great day.